Hi everyone, this is Sana and Mona Ali here from Property Twins. Hope you are doing great. Today's topic is really us looking at unpacking a couple of deals for a client who's built a property portfolio over a period of time. So we often hear, how are people able to build a property portfolio? How are they able to actually move from one property to the next?
And that is a function of the right finance and the right property selection. Obviously, there's different property cycles that we go through, but the story or the case study that we are going to share today shows you how to sustainably grow your portfolio from one property to multiple properties. And we'll be talking about the two investments they bought after their home,
while saving tax and minimizing risk. So they've set themselves up for the future, starting with their first property all the way to 3 properties in their portfolio, including their home. So deals unpacked, 2 times property deals and this client's finance structure. That's what we will be going through today. So firstly, we'll go through our client's background, and some of you may relate to where these clients were at. So when our clients actually came to us back in June 2018, they were first-time property buyers. Jane is a chartered accountant and John is an engineer, and they were facing a couple of challenges which many of you might relate to because it's quite a common conversation we have with our clients. So being first-time buyers, analysis paralysis, like you don't know what part to take. You might be confused, because there's so many options available. Should you be buying off the plan? Should you be going for house and land packages? Should you buy your first home? Or whether you should go down the investment property path. So we were having these conversations at the time, and the key thing was they had this fear of making expensive mistakes. Obviously, you're spending hundreds of thousands of dollars. You don't want to be buying the wrong property because it's going to impact your future and it's going to impact what you end up doing down the track all
I'd
up.
like to add they also had confusion from the market as well, right? Where the market dictates pay less now, but you end up paying more later with bad finance setup or buying overpriced brand new properties, or even what causes more confusion for most people is talking to friends, family, and colleagues who've gone a certain direction and they think it's just the right path and receiving unqualified advice.
And also for these clients, they had actually been to some property seminars as well, where they were being talked into buying off the plan properties and being promised a future, like a part, like it's an unknown. I know in any property deal, it's an unknown, but you can make calculated decisions, which end up paying off down the track. And also they didn't know what to buy, where to buy, what price point, and what actually makes a good deal. So there was a lot of question marks as to what direction they could take. They really didn't have the steps that they could take to kickstart their portfolio and work towards creating wealth down the track. And ultimately, they wanted to use property to generate wealth. Like most of our clients or people in this group or the audience here, the idea is to utilize property as a wealth generation tool so you could create your financial security, stability, and control. So now we'd obviously go through the finance strategy here. So effectively for these clients of ours, they went from being home buyers to buying 2 investment properties over a span of 3.5 years. So firstly, actually based on the numbers that we did, we looked at various scenarios as to what they could do, home versus investment. They decided that they wanted to go down the path of buying their own home. And it's a very common conversation that I have with first time buyers as to whether they should go down the home path or the investment path. So what we do for our clients is obviously compare the 2 scenarios and have a discussion, pros and cons of both approaches. How does it impact their future? So in this case, these clients decided that buying their first home was the right thing for them, which they purchased in Sydney for about $690,000 with lender A. Let's call it lender A. What we did was we chose a lender which allowed them maximum flexibility. So they had a flexible loan structure to enable use of tax effectively. So we wanted maximum flexibility for the future for when they were ready to build their portfolio. Too often people get stuck with the wrong bank where they have no flexibility with the structure. So if you are a first time buyer, or even if you have a loan with a lender which is inflexible, you need to make sure that your loan is set up with a bank which gives you maximum flexibility, so you are set up for the right opportunities as and when they arrive. So the average property investor might be choosing a bank just based on the lowest rate and lack of flexibility. So you need to really be aware of what you're getting yourself into and how it will impact your future decision. So yeah, so year one, bought their home. Then over a course of about 12 months or so, they saved up about $85,000 in cash savings. And their home loan, like their first home loan, was set up with the right bank. So we were able to tweak the structure of their owner occupied loan so that they could use their $85,000 savings towards an investment property and have that $85,000 tax deductible. Obviously, it's subject to tax advice, so you do need a good tax accountant on your team. But from a best practice point of view, we tweak the structure of your home loan so you could use your cash savings effectively, whereas the average person out there just takes the 85 grand and puts it as a deposit for an investment property. So what it meant for our clients was about $15,000 of tax savings over the life of the loan. So I'm curious though, if you are a homeowner and have built savings and all, like, would you want $15,000 in tax savings? Like, what would you say to some, like, if you were told that you could save $15,000? As a result of us doing this, I mean, and the savings being built up, these clients purchased investment property number one for about $430,000 approximately. Over the course of about 2 to 3 years, it's worth about 740 grand. We chose the correct repayment type so they could save on tax and prioritize paying off their owner occupied loan first. So again, this purchase was done with lender A. So investment property one was purchased with lender A using the 85K in tax savings. Then as time went on, right, property values rose a little. So these clients were able to tap into the equity from their home of about 97 grand at that point in time. And additionally, we looked at refinancing their investment property number one to lender B and accessed about $136,000 in equity. So that came from the equity gains that had happened over time. So as a result, they were able to use these equity cash out, 97 grand and 136K, to put as a deposit for investment property two, which they purchased for $660,000. So yeah, the two equities, lots of equities were used for this, and this was done with lender C. So these clients have actually navigated all the way from lender A to B to C and have got 3 properties in their portfolio over a span of 3.5 years.
I'd like to add, right, the average person, as you said, one pulls out money off their offset and goes and buys that investment property, they've instantly lost, for example, in this case, $15,000 of tax saving over the life of the loan. They have made it a bigger task to pay off their owner occupied when those savings could have been used to pay off their home and reverse compound, pay it off quicker. And also what this shows is there's no straightforward answer to this, right? If you just go to your one bank, you don't know what's out there, how you can structure the loans, how you can expand the portfolio or tap into the equity to move forward. And this strategy evolves over time, right? When we started with their home, we didn't know where we will end up, but what they had was the flexibility to move forward. And 2, we helped them navigate to a different lender where they could maximize the equity and the ability to purchase. And also with time, with Jane being a tax accountant or a chartered accountant, there will be LMI waivers as well that they can avail in the future.
Yeah, the idea really is you need to look at your circumstances holistically, your own bank. Maybe it's convenient. You might just be able to walk in and get a loan, but is it actually being done strategically, or is your focus just on the lowest possible rate? Yeah, sure, we all want to minimize interest rate, but you need to look at it as to how does it actually enable me to move forward now and into the future. So it's quite a strategic approach. It's just like a puzzle. You're putting it together, you're finding different pieces, or maybe like a game of chess, right? You make different moves over a period of time. So that's something to be mindful of if you are looking at building a portfolio. So if you are say a first time buyer and you don't know which direction to take, and you want to use property as a wealth creation tool, so you need to start looking at it strategically and get appropriate advice on this.
Also need to be mindful, right, that market goes through ups, the market goes through downs, but you have to look at a longer term horizon, right? What's today may not be tomorrow or maybe in 12 months. So you have to plan ahead in terms of where you're heading and set yourself up to be able to make those moves, because most people just think of the now and not the future.
Absolutely. So with these clients, so their total portfolio is about $2.1 million over a span of 3.5 years. Of course, some of it will depend on your income, resources, and the lending climate as well. But if you can set yourself up right from the beginning, then you'd be able to tick off these goals over a period of time.
So moving on to the properties they bought, the two deals, right? We wanted to talk about their first purchase, which is this house on the left. The price was around $430,500, and the rent at the time of purchase was $450 per week, and the current market rent is $550 a week. So as you can see, it's gone strength to strength with rental increases given the current shortage, and rental yield being 6.64%. The location is Southeast Queensland, 3-bed, 2 baths, 1 car spot. The current value is circa $740,000. So this purchase, right, we keep hearing in the market, oh, there's a cliff, or we're going to see a cliff, and these guys just really backed themselves when nobody wanted to buy, they got into the market. About the property itself, great location, walk to amenities, train, shopping mall, more than 600 square meters block. And it's also zoned for future development. So they can potentially put granny flats or even duplexes or townhouses subject to council approval. The property was poised for short and long-term growth. It will continue growing over the longer term, and a set and forget property. It will eventually pay itself off with the way the rents are going, and 71.89% capital growth in 3 years, which is 24% per year. Obviously, property doesn't grow in straight line. There's times when it's never linear, the growth. So there will be times it will grow a lot for some years, other years it would be stagnant. So again, it brings us to the longer term horizon of property. It's not get rich quick. It is based on cycles. It's your time in the market rather timing in the market. Selecting the suburb, again, this market poised for growth. The area had been rezoned and properties were in high demand, high rental returns, and vacancy rate of just 1% right now in the market, and infrastructure in surrounding areas to fuel capital growth over the longer term.
And I guess for this particular deal, these clients really backed themselves and made the decision when nobody wanted to buy. As you said, Sanam, nobody wanted to buy at the time. So they took advantage of the market conditions. And it's a hindsight thing, right? And hindsight is indeed very beautiful for them, because this is done quite well, and their decision of backing themselves has actually really paid off for them.
And there's a lack of supply of quality properties, because it's been hard. Right now in the market, it's been quite challenging securing deals, right? Quality deals. There's lots of C-grade properties, but lack of supply of good quality properties in the area as well.
So in terms of deal number 2, which was purchased a year and a half or so later, so purchase price is $660K. Rent at the time of purchase was $500 per week. Current market rent is $600 per week. So again, this was in Southeast Queensland, 3-bed, 2 bath, 1 car spot. So quite a large house. Current value is still $660K odd, but obviously rental yield has increased significantly. So the property is in a great location, proximity to all amenities. This is actually 1,000+ square meter block, which can be zoned for future development and could have granny flat potential there as well. So it's a long-term land banking exercise for these clients, and it is poised for growth in the mid to long term. It's a set and forget buy and hold property for this client. In terms of suburb selection, so in the suburb, there's lack of supply of quality properties as well, because it's a more affordable pocket, but there's fewer and fewer properties coming on the market right now, or good quality properties coming on the market, which will push prices up. High rental returns with only 0.6% vacancy. There's infrastructure in and surrounding areas to fuel growth. And given, obviously the large block size and, lack of properties coming on, these clients are set to do well with this property as well.
So what I want to know from you guys is, well, for one, what you took away from today's session, and two, which of these properties do you prefer more or like, or what do you like about them, and what have you done in your portfolio? Would love for you to share in the comment. I think Sadaka has asked a question as well on the live. $85,000 first year, assume their savings from salary, not understood the 15 grand. So 85,000, correct? It is the savings they've built. So if the loan is structured correctly and they use the 85 grand tax effectively subject to their tax accountant's advice, they will get about $15,000 in tax returns over the life of that loan.
Yeah. So, and I guess moving forward, I guess for if you are a first time buyer or even an existing homeowner and you dream of creating wealth through property and also set yourself up and your family up with financial security, stability and control, you need to have a strategic approach and look at where your portfolio is going. It's not about just a transaction in isolation, because many people treat mortgages as a transactional approach, but it needs to be a long-term approach. How does it fit into your big picture? How are you setting yourself up for the longer term? And I guess if you are confused as a first time buyer, should I go down the path of buying my first home or should I buy an investment property? Then obviously look at both scenarios. We do numbers for our clients and say, well, this is how this looks like, this is how this option looks like, and how do these actually compare and tie into your long-term goals and where you're headed in life. So I would say don't treat it as a transaction, not as the lowest rate, but how is it actually going to enable me to progress long-term?
So guys, any questions, pop them in the comments, and Thirat will also be putting in a link in the chat. If you would like to schedule a time with our team, you can do that at meetme.so/property twins. That's meetme.so/property twins. It's an obligation-free initial chat, and we can get the strategy started for you and get you moving on your goals, and looking forward to hearing from you. Thanks, guys.
Thank you all.
Bye.
Bye.